We start the session today. Last week was an introductory class, and we look into definition of entrepreneurship, entrepreneur. We look at some characteristics and skills needed to be a successful entrepreneur. We also look into the life cycle stages of an entrepreneurial ventures. Okay, this week we're going to look at developing business ideas. As we discussed last week, that every business starts with an idea, right? Idea doesn't come always. There is rigorous, steps or procedures to follow to get a good business idea. Ideas may come at any time, but we have to screen through and we have to find out whether that idea is feasible or not. The idea is something rational, something logical, and the idea may bring profits to your ventures, right? The reason we like to invest or start a new venture because we like to make money. As we argued last week that in any business, we invest because we want the money to bring more money, right? So when you invest, we have to make sure that the venture that we are exploring should bring enough cash flows to sustain, as well as giving you extra cash flows, okay? So that's the reason we start up a business. So getting a good idea, that is the most important thing. When we ask the students, even I asked you last week, how does a business start? Many of you argued that it starts with capital, right? Money, you need the money first. But then we argued and we said, no, a business will start with ideas. If you have a good idea and you convert it into commercial business idea, and you prepare a good business plan, then money is not a problem. Financing is not an issue anymore. Okay, so there are banks available for you to raise the finance. You have crowdfunding, business angels, venture capitalists, and many other avenues where funds are available, as long as you have a good, feasible, profitable business idea. With financing sources they would like to use, if they can understand that it is a good business idea and it's going to bring profits to them. So money is not a serious problem now, okay? So that's what we are going to look at today. We are going to look at how can we convert a normal idea into a business idea, or how can you make an idea into a commercial idea. Okay, so that's what we are going to look at today. So the learning outcomes, basically today we are going to describe at the end of the session, you should be able to describe the process of moving from an idea to a business plan or business model. You should be able to understand the components of a sound business model. You should be able to identify some of the best practices for high growth, high performance firms. You would be able to understand the importance of timing of venture success. You would be also be able to describe use of SWOT analysis and initial litmus test, okay, or when you test the critical factors that affect the business. You should be also able to describe the types of questions that reasonable feasibility assessment address, and well as the primary component of a business plan at the end. We'll look at that also, okay? So thus, this lecture is very comprehensive and very holistic in nature, and it does cover very fundamental issues related to a venture or commercial opportunities that is available, okay? And as you will be required to do a business plan, so you'll get also a preliminary idea how a business plan looks like, the contents of a business plan. That will help you some kind of, creating the mindset, what are you going to go through next year, okay, when you are required to do a business plan. Now, when we look at the types of firms that you have learned in corporate finance or some other subjects, we divide firms into sole proprietorship, partnership, and corporations, okay? But here is different. Here we are looking at entrepreneurial ventures where a new firm is being launched. Okay, new firm is being launched. So here we look at in a different perspective, and we divide the firms into three types of firms that an entrepreneurial adventure or exploration may look into. Okay, the first one is when you are just looking for an opportunity which gives you the cash flow which is just similar to the salary that you may receive from if you're working. Okay, so that's what we call salary replacement firms. Okay, firms that provide the owners with income level comparable to what they could have earned working for much larger firms. Okay, so if you find a job and say, for example, your salary is 10,000 ringgit per month or 20,000 ringgit per month, say, for example, and if you can venture into something new and you become your own boss and you create job opportunities for people, and yet you can only earn about the amount that you can earn from working with a corporation. Okay, so that's what we call salary replacement firms. I remember when I was doing my first degree, BBA, which I graduated in 1993, some of my friends, they venture into small businesses. For example, like even selling nasi lemak in the morning. Okay, and they told me at our time with BBA, they could highest the salary they could get was about 1,500 ringgit. That is 1993, 1994. Okay, so my friends told me that if they sell nasi lemak in the morning, they could earn similar amount of money. So they decided to open up a small shop to sell nasi lemak in the morning. So they do not want to work with others. Okay, so that is kind of example, salary replacement firm. You open up a small venture. You may run it alone, or you may have just one, two workers to help you. That's how we start small ventures, and that may just give you a kind of income which is comparable to the salary you may receive from working for larger firms. Number two, the second type of ventures where firms will allow you to pursue specific lifestyle while being paid for doing what they like to do, meaning that this one is a bit more than the first category of firms that an entrepreneur may venture into. Okay, so here you are looking into a venture which may give you enough fun to live your life in a way you like to. Okay, so you have certain kind of lifestyles which salary was not enough and need something more than that. So this kind of ventures opportunities may give you some extra cash flow that helps you to maintain your lifestyle that you like to have. Okay, this is the second category of entrepreneurial ventures that we'll be looking into. Okay, the third one is known as entrepreneurial ventures. Entrepreneurial firm basically it is performance oriented, and your salary would be flowing. The cash flow would be flowing. So as you start with a low income, but slowly you start into going into growth and you sustain and gives you millions of dollars from a business. So you will have rapid growth and thus rapid value creation over time. So possibly that is what we want. Possibly that's what a government wants, the government of a country wants us to do. So when you graduate and you venture into a new business, then we expect you to start small, but it sustain and start growing. Okay, and then you employ more and more people, and you start adding more values into a service, product and services, and you start creating value from the company. So it's basically performance oriented. So this is like you are going for a venture. Obviously, start as small and then sustain the first 2 years and even 5 years, and you sustain over time. And then it becomes like a corporation in your future. Okay. So that's what we argued last week, right? We said those commercial opportunities that we create and entrepreneurial ventures started, 30% of them will close down within first 2 years. And then another about 30%, 40% close down in 5 years' time, meaning that 70% entrepreneurial ventures will not survive after 5 years. Only about 30% venture survives. Okay, so this is what it is. So you are starting with small, and then you keep focused, be committed, and then you are performance oriented, and thus your ventures stays and sustain, and then you start growing, and then rapidly add values to your company. All right, it creates value over time. Okay, so these are the three types of firms that you look at. So do not get yourself confused with the other three kind of firms that you look at. Sole proprietorship, partnership, and corporation. Those are the industrial firms that you look at. But here we are looking at from the perspective of entrepreneurship, okay, from the perspective of an entrepreneur starting with new ventures, okay. So this one may not be a sole proprietorship, may not be a partnership, may not be a corporation, okay. Rather than you start an owner, but it goes through certain stages, and then you will become bigger. Then you may convert into partnership, or depending on the sources of finance that you avail to run the business. Now, when we are looking at a business model, when you have ideas and you are evaluating or measuring or screening the ideas, then the most important components that we got to look at, which is very important, and that's what we every year when we evaluate the business plan of our students in year 3, when you are required to submit a business plan with the guidance of a supervisor. For me, with finance background, the most weakest part that we see in the business plan is the financial one. So we don't really find a sound business model that brings create or generate more revenues, make profits, or even bring more free cash flows. Okay, that's usually being missing. We see a lot of analysis on marketing, product operation, and management, but when it comes to finance and accounting, we just see just 3 pages, a pro forma balance sheet, profit and loss account, a cash flow statement, which are not enough. Which, when you have a business idea, you have to prove to financing sources that your business idea is a sound one. Your business model is a sound business model. That's what you want. Okay, so we have to prove that this project or venture will generate enough revenues to sustain. Okay, we have to identify the customer, the niche customer that we are going to focus, and we have to show that the sales will keep increasing over time. Thus, it will show that the business is going to sustain. Okay, so revenue is basically what when we sell and get the cash, right? That is revenue. But then second stage, you look at profits. Sometimes we look at a venture whereby we sell a lot and we generate a lot of revenues. But then again, because of having less focus on costing, then we end up, the costing and revenue become similar. So we end up doing nothing, getting nothing, no cash flow available. So while we operate, we have to make sure also that our generated revenues are more than the cost or expenses, especially expenses, the cost at the beginning, right? So we have to make sure that our revenues exceed the expenses so that we make a profit for a venture. Okay. Before proceed on, let me ask you a question. Can anybody with me now differentiate the cost and expenses? Anyone? How do you differentiate cost and expense? These two terms are commonly used in most of the ventures, business ventures, right? And since we started your business studies, you have been going through these two terms, right? Listening always these two terms, cost and expense. But do you understand what is the meaning of cost and expense? Anyone? Anyone would like to try? Please. Can I have anyone to try? What is the difference between cost and expense? Aisha Karim, are you there? Hi, Aisha. Aisha doesn't want to respond. Okay. Ang Shi Un, are you there online? Hi, are you there? No?
Sir, can I try?
Yes, yes, please. Thank you.
Cost is refers to like cost of production, and expenses is like rent, utilities, and other fixed expenses.
Okay, Nurul Ilahi. Thank you. Thank you so much for replying.
Because, sir,
Uh, your answer is very close to right answer. Basically, cost is fixed mostly. We do have variable costs as the production increases, the variable cost will increase. So cost is basically when we initially go up to production, right? From the beginning of buying assets and then up to going to the production process. Okay, so that's the cost, and expenses are after that. Okay, additional ones. Say for example, your rental, your electricity, your water bill, your salary to the employees, and all those are the expenses, additional one. Okay, so I put a simple word for you. Cost should be initial one, and the expenses are the additional one. Okay, so when you start production, the initial expenses that you do all are categorized at cost. Okay, and then when you have additional thing that comes up once you start production, that become expenses. Okay, so I think Ulilahi has given she has given even examples of like cost of production is a cost, and she's saying expenses are rental and all that, which is correct. So you have to remember two keywords here. Okay, the initial money that we spend, initial money, buying land, buying materials, buying the building, building cost of building your company, the premises, all that, buying your of machines, materials, all those will be the cost. Okay, so certain costs are fixed costs, as you know, and certain costs will be variable costs, because when you exceed the limit of the current facilities that you have, so you may have to acquire more. So then you will have a variable cost. The more you need to produce, the more variable cost should be there. So initial money is spent is basically cost, and the additional when you spend it become expenses. Okay, all right. So first of all, our focus definitely on revenues. We have to generate enough revenues. But then after that, we have to also make sure that our cost or expenses are not more than the revenues. Okay, so expenses should be less than the revenues. That's how we end up making profit. Now, if you look at the profit and loss account that we prepare, how do we start? We start with sales, right? So sales is the revenue minus cost of goods sold, right? So sales minus cost, then we get uh, the what do we get? We get got profit margin, right? We get gross profit margin. Then only after expenses, then we get the profit before income and taxes, and we minus it, then it become net profit. So once you have the revenues, then we deduct the production costs, right, per unit, or the whole bunch that you have, and then we minus the expenses, then only we have the profit there. Okay, so we have to generate another revenues to make sure we at the end we have some profits. And sometime also when we make sale, most of the sales are on credit. Okay, most of the sales are on credit. Why we sell on credit? Because when we sell on credit, encourages more sales. Okay, the sales will usually increase. Okay, so in order to increase the sale, we give credit to the buyers. So they will buy on credit. So they just send us a purchase note, and we send product, we transfer the goods and services with a sales invoice. Okay, so that's how it works. And we do not know when we are going to collect the money. Okay, but of course, when we have credit policies, we lay down there. Possibly, if they want to enjoy the discount, we give them 15 days to pay. If they don't want to enjoy, they cannot pay within 15 days, so no discount is given. They may continue up to 3 months to pay normal payment. And they fail to pay within 3 months, then they will lose. There might be a chance for extra for late payment. All right, or possibly the company may list them as a defaulter for failing to pay within 3 months. So next time they will not be allowed to pay on credit. Okay, so buy on credit. So when we are selling on credit, as we say, almost 90% sales of companies, okay, are on credit. Then what will happen if it is on credit? Where you have bought raw materials, you have bought machineries and all that, your money is tied up. Now, when you make sale, of course, you need cash to come back, right? Because your monies are tied up. So you need to get back the money. And when you are tying up your money, this money are not coming from your pocket. Possibly it came through the bank loan. Possibly it came from venture capitalists or business angels. So you have to pay them back. So the third one, very important one that we have to keep in mind, then we have to produce enough free cash flows. Okay, so there should be enough cash flows available to run the business. That's what we call net working capital. Okay, so we have to have enough cash to run general operations that you do every day. Okay, so these are the three very important components of a sound business model. Okay, we have to make sure we sell enough so that we generate adequate revenues, okay, to sustain. Then just generating revenue is not enough. We have to make sure we manage, control our costs and expenses so that we end up having some profit. And just having profit on paper in the profit and loss account is not enough. We have to make sure we have enough free cash flows available to run daily operations. Okay, so these three are the very important ones. So when next year you will be doing your business plan, make sure you keep focus on this, okay? Because a business is necessarily starts with in mind that the money you are investing should be able to bring more money for you, okay? So the cash being invested should generate more cash inflows, okay? So that's the idea. So these three are the very important element that nobody should, be less concerned about, okay? So sometimes we focus too much on marketing and sales, and we forget that we got to manage our cost and expenses also to end up, having profit and also maintaining good free cash flows to run support daily operations. All right. Any questions so far? Anyone? No. Okay. Now, let us look at some of the best practices for high growth and performance firms. Of course, there are some key elements that we got to look at and see what are the best practices available for those have been successful. Okay, so the next few slides that you see are basically prepared based on the analysis of the firms which have been very successful. Okay, they maintain high growth and good performance from the beginning until they sustain and they continue operation as an entrepreneurial ventures. Okay, so these are the three areas that we will be looking at seriously, right? The first one is marketing, because that helps you to generate enough revenues, right? And then you look at financial practices. That's what help you to control the costs and expenses, and making sure you collect enough cash flows, right? You generate enough cash flows. So that's what we discussed in earlier slides. And the third area also the management practices. Management involves making decisions every day. Okay, certain decisions are almost, of course, made in the marketing division or financial division, but the critical decisions are made at the management level. Okay, so every decision made by the management, the leadership, the managers, and the leaders of an organization will have severe impact on marketing and financial practices. Okay, so we look at the three most important one, but here we put a note. Of course, the operation and production, even though it's not listed here, is because when you look at marketing, financial practices, management practices, the three automatically covers the operation and production practices. All right, so we are not classifying it with the different headlines here. Now let us look at the best marketing practices. What makes a company successful? Okay, so you start with generating adequate revenues. Okay, so deliver high quality product services. Okay, so the definition of marketing was basically, since you are not responding yet, so I give you some time to get used to with the class. Marketing is what? Marketing is basically creating the needs and then producing products to meet those needs. Okay, so marketing is not necessarily producing, pricing, and promoting, and all that. It's not necessarily that. Rather, the true definition of marketing is basically creating uh, needs of a product or services and then producing product services to meet those needs. Okay, meaning that you look for opportunities, find out niche where there is no such product in the market, but there is a need of the market. Okay, the people don't feel like they need that. For example, like when there was no mobile phone, and none of us we thought we need a mobile phone, right? So we used land phone, and then the telephone boxes that here there, the booths available, we used to use them. We never had an idea before the handphone come in. So the marketers, they created the need. So marketers actually come out with the idea, why not having a smartphone in hand so that you can be in contact with your networks, your friends and families always. So there's the need been created. So they start advertising, promoting. And then we feel like, yeah, it's a good idea of having a mobile phone. So they create the needs and then they will produce the product to meet those needs. That's the definition of marketing, okay? So to deliver high quality products and services, the best practices, in marketing, develop new product services that are considered to be the best. Developing new product services, we develop new products as marketer, okay, or new services that are considered to be the best. Offer products or services that command higher prices and margin. That is basically to make sure we generate enough revenues. Okay, we end up having profits and we generate enough cash flows to meet daily obligations. Okay, so offering product services that command higher prices. So you have to make sure when we come out with new product, it is competitive in the market, it is better quality than your competitors, and thus people are willing to pay you more, okay, to buy your product. And that's how we end up having more revenues or profits and cash flows. All right. And number 4, develop sufficient distribution channels and superior service support facilities. Okay, there are two things here we need to remember. As a marketer, we have to make sure that our distribution is efficient. Okay, I'm very sure all of you involved in online shopping and all that now. A certain product you order and it arrives within 2-3 days, you feel very happy. And some product you order, it takes like 3-4 weeks. Definitely, you're not very happy with that, right? So if similar product and similar price and delivery is faster, definitely you will go for that kind of product, right? So your delivery, your distribution, supposed to be the channel is supposed to be very efficient. So you have to develop that distribution channel to make sure you reach to customer faster than your competitor. That makes you a market leader. Okay. And then once customer buy a product, and that's not the end, is the after sales service, which is now more important. Okay. So once a customer buy the product, and then they have somehow found some difficulties, some problems with the product, then immediately if they contact you, we should be providing the services to them. Okay. Just to give you a simple example that I have gone through last 3 months before. I bought a Dell computer, the Dell Inspiron, and then when I got it after I think 7 days or 4 days, I cannot remember, 4-5 days. When I opened, then the cover broke, broke with the frame. So then I contacted the Dell, and then I think within 3 days they sent the person from Aloista to come to Kanga. And the person came to my office and he spent about half an hour to 1 hour and he repaired it, within that time. And he told me that this set is actually having problem. Every customer having problem. So initially I was very upset because I bought a new computer and within 3-4-5 days is giving me trouble. Of course, you can feel how my feeling was. Of course, you will have a similar feeling. But then when they responded immediately and sent people to service it and make it like new, of course, it gives you, it eliminates the negative feelings that you have in your mind. So after sales service is very important, okay? Very important. As we in marketing, you know, there are two very popular term we use. The first one, we say the first impression is the last impression. So when you see the product, you smell the product, you feel the product, you feel like it's a good one, you have to buy it, and you bought it. And then after that, we say the last impression is the lasting impression. Okay, that's more important now. The last impression is the lasting impression. So you bought a product and you start using it and you feel really nice, it's very good. Then you continue buying the product. That's what we want. Huh? We want to create the customer loyalty. So if people are buying my product, I want them to continue buying my product. Okay, so they will only continue buying product when they have good impression after using it. So the last impression is the lasting impression. Okay, sometimes, you know, in our life we meet people, and at the first meet we like the person, maybe because of his looking, the way he talks, the way he cares, and all that. But after meeting few times, you don't really like the person, you know. And sometimes we see a person we meet, we don't really like the person, but as we meet more and more, then we start liking more and more, you know. So that's what is marketing, you know. So first impression is the last impression, may not be right, but it's more, or last impression is the lasting impression. Okay, so that's where the marketers should be focusing. So you need to have quality product, you need to have quality, you know, services, and then your distribution channel got to be efficient and excellent, and yet at the end your after sales service got to be a very good one, you know, is better than anyone in the market. That what makes you sustain as entrepreneurial ventures. Okay, anyone has a question on this, on the best practice in marketing? Anyone? No, huh? Haris, is it clear so far? Haris? Hi, Haris. Haris, are you there online? Haris, are you there? Not there. How about
No
Dareen?
questions, sir.
No question. It's clear, right, so far?
Clear, sir.
Okay, okay. Thank you. Let me proceed to the next slide. Now we look at after marketing. So we discussed about marketing first. The reason is why? Because we have to make sure we sell enough, we generate enough revenues, profit, and cash flows. Okay, so that's how we look at marketing first. Then we look at financial practices. Okay, now, say for example, your entrepreneurial ventures generate adequate revenues, adequate profit, and adequate cash inflows. But then, if you do not manage, control your costs, then you are going to have problem. Okay, so the second area that we look at critically, uh, that is financial. Okay, so we have to have a detailed monthly financial planner. Okay, and that's what we do at the beginning. I think the business plan, this is one of the important elements, as I said earlier. So we'll have some forecasting there, how much we are going to sell and how much we are going to cost to produce the product and what would be the other expenses. Okay, so we'll have an annual plan, and most of the time, every firm, an established firm, will have 5 years plan, and based on that, they will divide into year one, year two, and so on. Okay, so we have to prepare a detailed monthly financial planner. Then we anticipate and obtain multiple rounds of financing as the venture grows. Remember, last week we look at the 5 stages of life cycle of entrepreneurial ventures, and we have understood that we have different kind of financing at different level of the growth of entrepreneurial ventures. Okay, efficiently and effectively manage farms asset, financial resources, and operating performance. So that's where coming the cost and expenses. Okay, so we have to make sure we control the costs and we manage operations expenses that incur daily basis. Okay, and then also we need to have an exit strategy. Okay, uh, because businesses, certain businesses may not uh, uh, just give me a few minutes just to uh, yes, hello. All right. So when you start a business, a business cannot, may not, even though we assume that the business will continue forever, but there are certain kind of entrepreneurial ventures we do, it may not continue for longer, so we have to anticipate, and we have to plan for an exit strategy. Say, for example, you're starting uh, to produce a certain kind of product that may not continue forever. Say, for example, like now with COVID-19, if an entrepreneurial venture is started to produce face masks only, just face masks, and say, for example, uh, the other related product that we now use uh, to manage the COVID-19. So possibly that the market size that we have now, after 1 year, that market wouldn't be there anymore. So then you have to have an exit strategy. How are you going to close the operation? Okay. So you have to have that kind of plan. So like as I give you example of face mask, there could be many products like that where you need to have exit strategy, so that when you see that you don't have any opportunity to grow anymore, you can just exit, you can just stop operation and venture into new ideas and all that. Okay, so that also should be available in your financial planner. Okay, now the next one, of course, we look at best management practices. uh, Management is defined basically as what? Management is defined as getting works done through people. So those people are in management. Their primary objective to make sure those people are recruited and trained. They do what they have been assigned to do. Okay, so getting works done through people, and in order to get works done, we do have areas that we look at, right? What you have learned in principle of management, like planning, organizing, controlling, leading, and all that, right? So all these functions are there because we want to make sure the work given to staffs, employees is done efficiently and effectively. Okay, so you are assembling a management team balanced in functional area coverage and industry and market knowledge. So you have a balanced team to lead your organization. Okay, employ a decision-making style that is viewed as being collaborative. So here we are encouraging the management to be participative. Okay, because an entrepreneurial venture, if one person makes decision for everything or few person without including others who are directly involved with customers and all that, the venture may not sustain. So when decisions are made, it has to be collaborative. There should be some kind of participative, inclusive strategy, whereby you get feedback from everywhere, all the stakeholders, including the customers. So who get the customer feedback? Possibly the salesman, salespersons, okay? Who manages the finance people, finance department. Okay, so you make it a collaborative effort whereby everybody gives feedback, inputs while you are making a decision. Okay, identify and develop managers that support entrepreneurial endeavors. Okay, so while you are working with employees, you have to identify who are the productive one, efficient one, effective one, and then you provide additional training to make them leader. Okay, so slowly they become, the core business leaders in your company to support the operations you have. Assemble board of directors balanced in terms of internal and external members. So once as you grow bigger, then of course you wouldn't be able to manage by yourself or even a small team. The financing that you have may not be enough. So what do you do? We may register as corporation, and you get bigger, board of directors to get involved in making decisions, and also we get avenues to raise more funds to run the business. All right. So these are the three important areas that we always look at, starting from marketing, financial to management best practices. All right. I think we get a short break. Okay, we get short break for 10 minutes. Then after 10 minutes, we'll continue. Is that okay?
Okay, sir.
All right. Thank you. Okay, let's continue. There's a heavy rain in my place now. I hope you can still hear me. Am I audible? Can you
Yes,
hear
sir, we
me?
can hear you. Yes,
Can,
sir, we
eh?
can hear you. Yeah.
Okay, okay, thank you. It's a heavy raining here, and my office roof is on the tin, right? So that's sound, a lot of sound there. Let us continue. Let us continue. So before the break, we look at the three areas where the best practices should be made available in successful ventures. Okay, so look into that. Let us move into something else. Okay, uh, the time to market and other timing implications. The timing of getting into market is very important. Okay, so when we see opportunities available, to the person who is going to grab the opportunity first, he is going to be successful. So opportunities doesn't stay longer. Okay? So when there is an opportunity, we have to be smart enough, clever enough to find opportunity first before anyone. Then we grab the opportunity and we go into the market. We will make a lot of money. Huh? So imagine like for mobile phone, first those came in the first time, before even all those Android and all that. They made a lot of money, even though they are being phased out from the market. You may not remember, when the mobile service companies started. It came with Maxis, then Dizzy, and then after that you have, uh, the Malaysian one. So at the beginning, when we started using mobile phone, I remember, the outgoing call. When I make a call, uh, the charge was 10 cents per minute. 10 cents per minute when it started. And when I receive call, 5 cents per minute. That's how we started, in 1998. So you make a call 10 cents per minute and you receive call 5 cents per minute. That's how we started. So Maxis, at the beginning, by giving better services, they make millions of dollars of profit. Then the DC came in. Then we have Telecom Malaysia came in. So those came first, they make a lot of money. Like Google, when it came in, they got a lot of profits. All right. So even the Facebook as social media, when they came in first, they make billions of dollars of profit. So any business idea that is, business ideas are there. Business ideas are there. It's matter of finding it out. So somebody who can see it first and make it commercialized, he will end up getting very successful, becoming very successful, getting a lot of incomes for that. Okay, so the timing is very important. Okay, so first to market is very important, but yet again we say that first to market may not also necessarily ensure that you would be successful, because you have to make sure that you have best practices in marketing, financial and management aspects, okay, in an organization. But yet we have to remember that we have to be first in the market, and after that we have to have best practices available, okay, to maintain and sustain in the business. The initial litmus test. A litmus test is basically identifying critical factors that affect your ventures. Okay, that's what we call litmus test. Identifying the critical factors. So a viable venture opportunity creates or meets customer need, provides initial competitive advantage, and is timely in terms of time to market. Okay, so we are saying a business opportunity, a venture, would be successful, would be commerciable, would be uh, uh, you know uh, uh, profitable if we create and meet customer need. We provide some kind of competitive advantage with the competitors, and we are first in the market, and we meet the expectations of the investors. Okay, so that makes it a viable venture. Okay, viable venture. So in the litmus test, when we identify the critical factors that may contribute to the success or failure of our venture, we do SWOT analysis, which you are very familiar, right? Strength, weaknesses, and opportunities, and threat analysis, right? So strength and weaknesses are basically internal analysis. Opportunities and threats are external analysis that you do. So we look at internal factors and we critically analyze them, and we look at external factors and we critically analyze them. Okay, that's what we make it a SWOT analysis. Okay, so you look at whether customers are having unfulfilled needs. There are certain needs which is not being fulfilled. Looking at certain intellectual property right issues. We are being the first mover in the market. We achieve the lower cost, the cost leadership, higher quality of product. We are having the expertise and experience to service better to the customers. And also we do have some kind of good reputation to run a business. Okay. So these are the important areas that is very essential for us to analyze before we move on to start a venture. Okay, so that's what we call critical factors to be a successful venture. Okay, and we, in another word, we say critical or initial litmus test. Okay, so when you do initial litmus test, we do the venture SWOT analysis. We're doing internal and external analysis, and then we start screening the venture opportunities. Okay, so we are assessing the idea that we have, whether it has commercial potential to produce revenue growth, financial performance, and create value for the organizations. Okay, so you'll be screening the idea by using various means. Okay, so that's what we are going to talk about now in the few slides. So there are many different ways of doing it. Okay, we can do it using certain qualitative methods, or we may do it with certain quantitative methods available. Okay, so we'll be looking at both. When it comes to qualitative screening, we're saying that there are 4 factors that initially we evaluate. Okay, to see whether the venture we have identified is attractive enough to customers. Okay, so we look at from a very comprehensive big picture. So you are looking at the global trend, looking at the national level, the local level where we like to, produce the product and market the product. We try to understand the customer and customer needs. We try to look at the production and development challenges that we may face, and as well as we'll be looking at the financial term, whether we are going to really generate enough cash flows, profit, and sustainable profit, and also managing the costs. Okay, so these are the 4 factors we initially screen by interviewing people. So whom are you going to interview? Possibly the owners of similar businesses that have been in the market, similar businesses that have been very successful and sustained in the market. So we interview the owners, managers, and we get feedback and try to screen these 4 important areas that makes a venture attractive. Okay. We do also use venture opportunity screening. Okay, by employing certain quantitative methods. Okay, so we will try to quantify business areas, especially we look at industry and market. We collect data which are industry market related. Pricing, profitability, we are looking at the financial data and looking at the kind of management team there. Okay, so this is a replacement of your interview. So when you are interviewing the owners, managers, the leader of certain businesses, and you get feedback, then you collect data from industry to validate, to verify the information that you have gathered through the qualitative measures. Okay, so here we'll be looking at, say for example, this is, you are looking at industry market, you are looking at potential market size of the product that you are thinking of, or services that you are thinking of. You are looking at the venture growth rate, you are looking at the market share, and you are looking at the entry barriers. Okay, so these are the few areas that we look at when it comes to quantifying or doing a quantitative analysis on industry and markets. All right, then we look at the pricing and profitability. Okay, so we collect data from industry. those people are producing similar kind of product. Okay, from those data available by them, look at the gross profit margin, look at after-tax margin, asset intensity, and return on assets. So these are the important areas that that are quantifiable and easier for you to do a quantitative analysis using the data. Okay. And then definitely these terms are very familiar. I have explained to you earlier. Cost of goods sold are basically the cost involved in producing, providing services. Gross profit is basically sales or revenue minus cost of goods sold. Okay. And then you have gross profit margin, and then you have net profit, right? These are the terms which is very familiar to you. But what is more important is here, the return on asset model. So we look at return on asset, the amount that you have invested. From there, how much return are you getting? You know, so when a person is investing in a project, the reason he's investing, he has certain kind of expectation that he is going to earn that percentage of return from this investment. Okay, so say for example, if I deposit my money in the bank, say I get 5% return, 5% return. Then if I'm investing rather than putting money in the bank, I'm investing in the project. Of course, investing in a project is riskier. It may be successful, it may be unsuccessful. I may lose even all investment that I do in an investment, right? So when I invest in any business, of course, my expectation is higher. If I get 5% from a bank, of course, I would expect at least 10% from an investment. Okay, so when you are going for an entrepreneurship or entrepreneurship adventure, of course, you would like to expect some kind of, more additional, the return on assets. All right, so the asset being employed to run a business, you would expect certain kind of return to come in. So that's what we are looking at, right? So we look at high profit margin and low asset turnovers, okay? A low profit margin and high asset turnover. So there are two different cases available there. So you see here in the case one, when you have high profit margin and then you have low asset turnover, that's where you will have higher return on assets. But case two, when you have low profit margin by high asset turnover, you will end up having low return on asset. Okay, so when we are analyzing, collecting data from qualitative and quantitative means, then we may put it in the graph. Okay, so to show the potential investors that how business is going to look like. Okay, and these terms are very familiar with you. I don't think I'm going to explain that. Okay. The management team, okay, the management team. Earlier, we look at the best practices in the management, right? So we look at experience, expertise, functional areas. We look at flexibility, adaptability. We look at entrepreneurial focus in the business that you are venturing now. Okay, so when you are evaluating the management areas and trying to identify and establish the best management practices available, then we'll be also collecting data like that from the industry, okay, existing industry companies that we have. All right, so there are ways of looking at, right? We look at high potential or average potential or low potential. So we can quantify and we do an indexing and find out the value, and then we put it in a curve to see whether you have high potential. Okay, you have average potential or low potential of the adventure or the ventures that you are going to look at. Okay. Okay, so venture opportunity screening indicators. Okay, so we may have an indexing. So you quantify the values and we put it in a graph and we see whether that venture, the venture that we are going to look at have high potential or not. Okay. Now, the rest part of it, I'm going to show you quickly what includes in a business plan, the key elements in a business plan. Okay, so business plan is basically what? It is a written document that describes your proposed product or service opportunity, current resources, and financial projections, as we said earlier. So that's what we call a business plan. Okay, so whenever you have a good business idea, you may not have enough funds to run the business, but you can always have a good business plan and you can attract many avenues available there. You can borrow from bank, you can get venture capitalists involved in your business. You can even finance your project having business angels. You can go for crowdfunding. Whatever sources of finance you go on, every sources of finance you will require to have a business plan. Okay, and that's what we're going to look at. Okay, so what you have in the business plan is the first one is the confidentiality statement. Okay, so you will have a business plan contains information that considers or firm considers it as proprietary, right? So by accepting the business plan, the recipient of anyone who receive your business plan will understand this is something confidential. Okay, this is something confidential. So if you are planning a business plan or making a business plan, and you submit to a bank, and say for example bank do not feel like it is a feasible commercial idea and do not agree to support you to run the business, so then you go to the venture capitalists. Even they did not agree, go to your business angels. So whoever get your business plan, it ends there. Even though they do not support it, they keep it confidential, which is very important. Okay, so the key elements of a business plan at the beginning, you will have a confidentiality statement telling the people that it is confidential. Okay, this is only for the purpose of securing finance to run a business. Okay, now this is an typical business plan outline. You will have an executive summary, then you will have business description, the description of product, services, industry background, the venture or firm background, goals and milestones or objectives and all that will be there. Okay, so you will have marketing plan and strategies. You will have description of operations and support services available there. You will also have to show the people who like to finance your project, the management team that is available, the expertise and experiences, organizational structure, intellectual property rights, all that got to be there. And also you need to have sound financial modeling there. Okay, so whereby you will have pro forma income statement and balance sheet, you will have statement of cash flows, you will show the break-even analysis to prove how sooner you may reach at the stage of break-even. And also you will finally show them what is your need, the funding needs and sources available there. Okay, and then you will also have to show uh, the financials, the risks and opportunities available there. And of course, you will have your timelines and milestones at the end of your business plan. Okay. So these are the key elements of a business plan that we do, and you will be doing that in your next year business plan project under a supervisor. So I won't be giving you an individual assignment or group projects on it, since you'll be doing it in next year. Okay, so I will leave it for your understanding now. You understand and comprehend better, and hopefully next year you can put that in practice when you do your business plan. Okay. Now that's what I have for you for this week.